In my opinion, the Nasdaq is breaking out. You see how it got above the 200-day moving average here, QQQ. And it also, if you were to use Bollinger Bands, you would see that we squeezed here. We got a narrow range here between 275 and 300, and now we're squeezing and opening up out of that Bollinger Band range. Let me see if I can do it really fast. Technical up. Okay, Bollinger Bands. You might not be able to see it clearly with the moving averages, but you see how the blue bands are getting narrow. Once they squeeze in, they usually have an expansion outward. So you get a squeeze here, and then you get the expansion. Sometimes to the upside, sometimes to the downside. But I feel like this is going to be a squeeze to the upside, since what's happening with the Fed is deflationary. And when banks fail, they loan out less money, so that's going to be deflationary. More banks are going to be cautious on their lending, so that's going to be deflationary. So this is all good for inflation, and tech is a deflationary play. If you've ever noticed, usually when things become more tech oriented, that is deflationary itself. Look at it. Look at the iPhone. Look at how much that drops prices around the world. Regular services that the banks that used to take you this long to go do, you have to get in the car and drive to a bank and do this and that. Now you can just do it on your phone. Or to go buy a CD from a store, now you can just buy it on your phone. These make your lives much more efficient, and that's why tech is deflationary. Yes, tech is still cyclical, and it's affected by an economy that falls. But if you see this rally that we're having a stealth rally in tech, as I just pointed out to you, on the Nasdaq, and the rest of the market's pulling back. So the S&P is not performing as well as the Nasdaq. The Dow's up 1%, Nasdaq's up 2.5%, S&P is up 1.5%. Let's go look at our performance and value. So this is kind of a shocking number, but now the S&P is negative for the year. The Nasdaq's up 6%, and our brokerage account is up 5%. We were up 30% a few weeks ago this year. We were really blowing out the market, but when Silicon Valley Bank blew up, we had to readjust everything in the portfolio. We sold a lot of things for gains or minimal losses, and this is really what happened in our account. We had a lot of gains and things like, let's say, PTY. PTY, we're up about 10% in. And so when you check what PTY did on the chart, you'll see that it had a big move up, and we didn't want to take the gain, because we didn't want to lose the dividend. So you see it had a big move up from 12 here to almost 15. That's a 30% move, but then we've erased all of those gains. So everything in my portfolio looks like, I remember EDF, we were up 50% in that. We were taking profits along the way, but now it's pulled back to we're only up about 20%. So everything has had about a 20 to 30% drop in the last few days. Extremely, I wouldn't say disappointing in the portfolio, because we weren't mad that we didn't sell when we were up on all these things, because again, we would lose the income. If we sell and take the gain, we're going to have to pay taxes, and then where else can we go to pay our dividends? So we stay in these things for the long haul. Now, we're only up 5% for the year, which I said is very sobering compared to where we were at, but we're still beating the S&P. Now, one reason why we're still lagging today, we're down 3,000 when the market's up big, is because of Cornerstone. Cornerstone does this, okay? Around X dates yesterday, it lagged, and that's typical for Cornerstone. It had its dividend yesterday, and then today it's still lagging because while I don't know the exact reason, I would imagine it's because people take profits on those drip shares that I told you. Cornerstone drips shares. It's $6. So the NAV is way below the market price right now. The market price is in the 7s, and the NAV is in the 6s, and I've showed you that on past videos. We reinvest our profits at an automatic gain at the NAV in Cornerstone. So I think a lot of people are just selling those shares, trying to take a profit anywhere they can in a sketchy market. This is what happened with Cornerstone last year in the bear market. People weren't holding on to their shares and letting the gains ride. They were taking the premiums and running. So now look at Cornerstone. It's oversold, deeply oversold. Okay, I've been adding to shares, following the plan. I've been adding to Cornerstone and CLM and CRF. And I've been adding to the triples, the triple longs. Those are working out today. You see TQQ is up 7%, UPRO is up 5%. So this is what we've done to get back our lost performance. So we sold some things like PTY, like we sold half of PTY. You see PTY, excuse me, we had 10,000 in PTY, we had 10,000 in a lot of these different funds. We sold half of all these at pretty much gains to slight losses. Where we lost a lot of performance was we sold a lot of these put options. We closed these out to reduce leverage. Now, we didn't take losses on the puts. We took gains as well in these. But that raised our margin up to about 260. And then to get our margin back down to 237, we sold half of all the other funds like I just told you. So we sold half of PTY, half of everything that you see here that's in the $5,000 column. We used to have 10 of it before. We did start a new position today in EOS. That's a 4-star fund on Morningstar, and we used to have 10K in that. We sold that a few months ago. We're back in it now because look at it on its chart. EOS, it's cheap. Again, it's 4-star. It beat the S&P on a Morningstar chart on a $10,000 test. Look, it was at 18. Now it's at 15. It was formerly 25. So it has a lot of upside to go before it reaches old highs. Plus, it has a 10% monthly dividend, 9.8. So that's 4-star on Morningstar. Go check it out if you don't believe me. And it beat SPY on a $10,000 test in 10 years. So we loaded back up in tech, basically. And also we kept Calamos, CSQ. That is also a top quality fund on Morningstar, and it doesn't show the star rating on there right now, but it made as much as SPY over the last 10 years. Yet it has a 10% dividend as well. So we wanted to increase our exposure to index-related themes. So JEPI, BDJ, USA, BST, TQQ, and UPRO, they are indexes, but they don't have leverage, I told you. Cornerstone, we went hard and heavy into Cornerstone because they don't have leverage. And Cornerstone is the S&P, and CLM is the S&P, CRF is the Nasdaq. The top holdings of these funds are doing well, okay? So the net asset value of these are doing well. The market price is not doing well. I'm used to this. Cornerstone always does this. You have to remain patient in Cornerstone. It usually catches up and outperforms the market before its rights offering. So that's what we did. We consolidated everything into these index plays, the majority of which being more tech dominant. So TQQ is tech, EOS is tech. So because, again, we think tech is breaking out. I mean, how could you not think that tech is breaking out when you look at that chart? It's cheap over the long haul. It's been down. It's way off its highs since 2022. Another point I want to make, a point of contention, is that people think that stocks need to go back to pre-corona highs before they reach a bottom. Well, look at SPY. Okay, we already reached pre-corona highs, so that's one I don't understand. First of all, the pre-corona gains, the pandemic gains, a lot of them aren't going away. They might have given back some of the growth, but no one's going to stop buying pools because the pandemic's over. Pool is one stock in the S&P that's doing really well. I always love that stock, Pool. And yeah, they had some accelerated gains during pandemic as most people wanted to stay home, had to stay home, so they want to enjoy their home, so they bought more pools. Well, now look, I mean, people are going to stay home because they can't go anywhere else unless they want to double their mortgage rate. So people are going to probably reinvest in their own homes, which is why Home Depot and Lowe's are always sexy plays, and Pool, being in the S&P, will be no different. And the same goes for every sector in the S&P. While they had pandemic gains pulled forward, well, people have not given back all the trends from the pandemic. I use Uber Eats now, and I continue to use Uber Eats. I never used it before the pandemic. So S&P, we're here at the chart. Okay, I just want to show you that when you look on a 5-year chart, look, this little hammer right here, this red hammer on the gray line at 35. So 350, this red hammer, where does that coincide with? That coincides with here. Okay, the old Corona, the pre-2020 high. So 2020, we had a pullback and we got this hammer to the gray line, 35, okay? That is essentially where we were. We were a couple points below that, as you can see here on this chart. A couple points below at about 30, I don't know, 34. So we, in charts, usually make higher highs and higher lows on an uptrend. They don't go all the way back to the same lows. That would be a sideways valley that it goes in forever. You always have higher highs and higher lows because you're anticipating that last low. People already see the last low. It's too easy, so they usually anticipate it early, and that's what makes higher highs and higher lows. So I think the S&P has reached the pre-corona lows. Let's look at the Qs. That's S&P. Let's look at Qs because the Nasdaq is important. Let's look at it on a 5-year. When we go there, we see that the Nasdaq's also had a pullback of its own. So 5 years, the Nasdaq, we go on a 5-year chart. You'll see here, what's the pre-corona high? There's the gray line. It's the same thing. So 250, we almost tagged the gray line there for the Nasdaq, and Corona, we're just below that line, that 250 line. So, and then here's the other gray line that the red candle brushes up against, that gray line, these gray bars at the top. That's the new breakout for that year, and so we tagged that old breakout level here at 250. This red candlestick. So when the wick is twice as long as the candle itself, and that's usually a strong sign of a bottom and a price reversal. So we tagged that on the Nasdaq, and I just want to show you the Russell 2000. If you can see the S&P, the Nasdaq, and then the Russell, you get a pretty good idea of where the market is going. So the Russell was here, the gray line again, 2020. We've gone below that, so we've actually breached that gray area and touched the actual old highs of pre-corona highs 2020 for the Russell. So these are all the makings that you want to see for a bottom. Look, RSI's pull back. Okay, things are looking really constructive. 10-year chart. Let's take these Bollinger Bands off so you can see clearly. 10-year chart. Here we are, consolidating on the purple line, the 50-day moving average. This is what you want to see. So now let's think of the macro situation. Is the Fed going to raise rates? Here's why I'm getting even more bullish, because the Fed's probably not going to raise rates anymore. This is now the beginning of a new cycle, a new Fed put cycle. Now, they might raise rates 25 basis points in this next meeting to show credibility, but then after that, they could go as far as even just not raising rates anymore, and we're pricing in rate cuts already. But even if we go another 25 basis points the next month or whatever it is, that's still pretty low considering we have a strong economy, where we had a 3% GDP print from, I believe, the Atlanta Fed survey of this week, which didn't really get reported on. GDP again was 3%. At least 3%. That's strong. Unemployment, again, strong. So even if the Fed has to raise 25 basis points, the economy should remain strong. Meta, I believe, just laid off workers. This is what the Fed wants. Those workers will be snatched up someplace else, though, and they will find a job elsewhere, because the supply and demand for jobs right now is so tight. They will find a job, a replacement job. So they will keep consuming, and the GDP is 70% consumer driven. So those workers should find a job still. So anyway, we're going to raise our margin up more now, 237. We're going to get it back up to about 250 here if we have to, because margin, I believe interest rates won't go up as high as we originally feared because of this new development from SVB Bank. So the Fed's not going to be raising rates as much. We're already pricing in rate cuts. This is bullish for my margin situation. So I don't feel as scared to put on the margin due to interest rates weighing on it. More so just trying to worry about my leverage in a down market with my margin. And is now the time to be fully not, I wouldn't say fully leveraged because we still have 400,000 purchasing power, but is now the time to stay aggressive? I believe it is. I just showed you the charts of the S&P, the Nasdaq, and the Russell. I showed you that these are pretty good entry points for the long term. Okay, we're making about 98,000. It shows 97, but we're short Cornerstone by 5,000. 5,000 times 20% dividend is $1,000. So that means that we're paying $1,000 a year in dividends for this Cornerstone short. You can see here, Cornerstone, we're short here $5,000. That also lowered our margin by 5,000, and it also raises our equity by 5,000, which you can't see here, but our equity would have been something lower, but we boxed in these positions for Cornerstone, and it actually lowers our risk, so they raise our equity, but we have to pay the dividend as a result. But you don't have to pay the dividend if you get in, if you sell before the X date. So the X date was the 14th. So 13th here for, it says for CRF. So CLM was the 14th. So basically, if I don't, I hold the short for CRF until next month, until the 13th. And then, so I sell it on the 12th. I don't have to pay that dividend. So that $1,000 is not really coming out. It's just until the X date if I don't sell. And so we're really making about $98,000 a year. The banks only see what the income coming in from the dividends. They don't see the short money coming out. But again, we're not going to pay the short dividend. We're going to sell out before the X date. So, plus I want to remain a little hedged. Cornerstone, I mean, it's our largest position by far. So I want to remain hedged. And so we also want to hedge everything else out. The tqqs and UPRO, we made a video, 10,000 each made you $1 million over 10 years. So we're repositioning those 10,000 and 10,000. We've repositioned in the top weightings, the top Morningstar ratings, rated funds. So you know, BDJ 4-star, JEPI is an all-star fund, Cornerstone 4-star. This Russell fund performs terribly, but it has a nice dividend. So it's a safe way to play growth. BST, it's top fund, BlackRock fund. Check that out, what it made on Morningstar. So we've reloaded into these indexed funds, mainly Cornerstone, mainly these top other weighted funds, CSQ, again, JEPI. And then we've really loaded in these triples so that we can replace the lost performance from the sold positions, since we sold half these other funds. Like I told you, PFFA, PTY, this JEPI, they're separating this JEPI from this JEPI. I don't know why, okay, but they're together. We sold half of all these funds, and we did it for minimal gains or losses. And how are we going to get back that performance on the way up again? So we did it in the triples, tqqq and UPRO. Why don't we buy these funds again down here? Why do we sell? Because we don't know where they get their money from, where they get their leverage from. If they were forced to raise money now in a crunch, what would they have to take losses on to do it with? Some of these funds are being responsible and buying treasury bills and government bonds and things. And if they were to sell right now, they might have to take losses in the open market in those things. So I'm trying to just find pure index related names that either have no leverage or a different kind of leverage. UPRO and tqqq are a different kind of leverage. They don't rely on bank loans. They just have derivatives and instruments that make it move ×3 to the original indexes. So this is how we're going to get all of our performance back. We're only at 5% again for the year, as I told you, but I think that we're going to get that up if we stay in these triples, and if Cornerstone eventually bounces back, which I think it will. It's just always delayed. Hopefully this makes a higher high, higher low for us. Higher high, higher low. I hope this is no different this time. So, and it's going to be based on Cornerstone and those triples. And are we hedged on the triples? Somewhat. We have SPXU right here and SQQ. We have 5,000 in those. So they're not going to hedge us completely, but we have 5,000. So if the market were to just collapse for some reason, those would end up helping me in the long run. We've also added these other triples just for extra performance. Teckle, Midu, Soxl, because they were huge winners over the last 10 years. We did add to our THW day up 5%. you know, we re-added to some of these in this column. We have 1,500 in each of these names, and we kind of re-added to those and kept the other ones that are stock specific or shorts. We have those under 1,000 now. Or if they're risky, EWZ is emerging market, so it's riskier, so we have it only at 1,000. So OXLC, SVOL, we like SVOL, but it's 100% maintenance, so we have it down here in this column where OXLC, another 17% dividend, but it's 100% maintenance. So all the riskier names or the 100% maintenance are below 1,000. And we're preserving our equity as much as possible, because if this number gets to 0, I'm in a margin call. So if it gets, I have 10K in shorts approximately. I have 5K of TQQ and SPXU. I have the inverse of those, UPRO and TQQ. I have SQQQ, and SPXU is the inverse. I also have these shorts for Cornerstone. So we have about 10K short, plus a couple of these sector-specific shorts, FANGD, KWeb, TZA. So Yang for our China ETF, we have a short there. So we're hedged out to where we won't make a ton going down at first, but if we crash and keep going, they actually could end up making me whole again, these shorts. So that's the way we're playing the triples. We have them hedged with shorts that'll help us in a crash. We've upgraded into these 4-star names, index related funds, no funds related to debt or specific outliers that can move, like bonds or commodities. Those are small positions now, as you can see down here. Devon, small position. SJT, our trust play, royalty, oil trust play, small position. So we've upgraded in the higher quality plays. We've downgraded the lower quality with an emphasis on tech. You see it's kind of breaking out because now things are going towards what works in a deflationary environment, and also just what is cheap, and tech is the best value right now. So that's what we did. I hope you like this video. Stay tuned for more. Thanks.